Throughout history, the world has experienced multiple economic recessions, from the Great Depression of 1929, the dot-com crash of the late 1990s, and the most recent one, the 2008 global financial crisis. These events were devastating to workers, families, and global economies, yet the world emerged from these periods. Today, however, the world faces a very different kind of threat. For the first time, we may be standing at the edge of a truly global economic collapse, driven by two powerful forces, the AI bubble and the cryptocurrency bubble. Let's break down how we got here and why the risk is larger than ever before. Tech giants like Meta, Microsoft, Amazon, Alphabet, and Nvidia are locked in an intense race to build massive AI infrastructure, mainly data centers and advanced chips. The scale of investment is massive. In 2025, Meta spent approximately $72 billion on AI. Alphabet, Google, and YouTube owner spent up to $90 billion in the same year. Microsoft, on the other hand, spent $80 billion on data centers alone. And this spending spree isn't slowing down anytime soon. By 2030, big tech firms collectively plan to pour $5.2 trillion into the pursuit of artificial general intelligence, or AGI, a speculative form of AI that doesn't even exist yet. An especially worrying trend is the circular flow of capital. Tech giants invest in AI startups like OpenAI and Anthropic. Those startups then use the funding to buy chips, cloud computing, and other services from the same tech giants. For example, Nvidia invested $100 billion in OpenAI, which would in turn purchase Nvidia hardware used to train AI models. This circular capital flow pushes up stock prices without generating true economic growth. It mirrors the feedback loops that fueled previous market bubbles. What makes this even riskier is that companies are increasingly relying on debt, not profits, to support these enormous capital expenditures. The Bank of England has warned that trillions of dollars in debt will fuel AI expansion over the next 5 years, creating a fragile foundation that could collapse if AI valuations fall. Other countries are racing to keep up. China alone is projected to spend $125 billion on AI in 2025, backed heavily by government programs. This international competition pushes AI spending even higher. And the rise of AI spending has sparked a rally in AI stocks. Investors who are afraid of missing out are pouring money into AI stocks. As a result, the top 7 AI-linked companies now make up 35% of the entire S&P 500, up from 12.3% in 2015. The extreme levels of investment comes even before many AI startups demonstrate profitability. This resembles the dot-com bubble in late 1990s, when companies were valued beyond their real worth. Also, the excitement of this technology is based on hype rather than reality. Some expectations like AI replacing all jobs or revolutionizing entire economies overnight are exaggerated. In fact, many AI systems remain inefficient, unreliable, and difficult to scale. According to a survey by S&P Global, 42% of companies have abandoned or reduced their AI projects due to high cost, poor performance, lack of expertise, and unreliable results. At the end of the day, AI investments can only be justified if they produce massive real-world profitability. Many companies adopt AI without a clear strategy for profit, leading to concerns that returns may not match investments. Without this, a correction is inevitable. If the AI market collapses, cryptocurrencies could fall with it. Since 2009, when Bitcoin was created, thousands of digital currencies have emerged, with many promising decentralized finance, anonymity, and freedom from traditional banking markets, promises that are yet to be met. And cryptocurrency markets are extremely volatile. Prices of these coins are driven by hype, speculation, social media trends, not because of actual utility. Many investors buy simply because they believe prices will continue rising. When confidence drops, prices collapse quickly. In addition, the cryptocurrency market, particularly Bitcoin, has a strong correlation with major stock indices. A sell-off in AI-driven tech stocks often leads to a decline in crypto prices. For example, the recent fall of Bitcoin prices below 93,000 US dollars in November has been attributed to fears over the potential AI bubble burst. Individually, AI and crypto bubbles are dangerous. Together, they form the perfect storm. If both burst around the same time, triggered by rising interest rates, debt defaults, or failed AI promises, the global financial system could face a crisis worse than the 2008 Great Recession. A stock market crash would lead to huge losses, not just for venture capitalists or financial institutions, but also for households. American households currently hold 129 trillion US dollars in financial assets. Of that, 51 trillion US dollars is invested in stocks. To put this into perspective, about 40% of household wealth in the US is allocated to equities. So if the market drops by 20%, American households would lose around 10 trillion US dollars of their wealth. A 50 market correction similar to the crash following the dot-com bubble burst would wipe out 26 trillion US dollars. But the crash would not be limited to the US alone. Instead, the shock would spread globally due to the interconnectedness of the global financial systems. The burst of the cryptocurrency bubble would add pain to an already painful situation. With a global cryptocurrency market capitalization of $3.2 trillion, a 50% sell-off would wipe out $1.5 trillion. A further decline in investors' confidence could lead to an additional sell-off with catastrophic impact. A crash of this magnitude would have real economic consequences. Consumers will cut their spending. No new cars, no home renovations, less travel, and lower demand across industries. Businesses will lose revenue, factories slow down, tailors cut orders, and a cascade of losses experienced across the entire supply chain. In the end, millions will lose their jobs, and there will be increased poverty and slower growth. And of course, financial institutions would become reluctant to lend, making it harder for indented households to borrow and keep spending. In response to the crash, the US government and other governments across the world would be forced to intervene through bailouts, debt relief, stimulus packages, and emergency lending. These include bailouts for pension funds and banks that have overinvested in AI and other institutions that are too big to fail. But government bailouts would translate to a significant increase in public debt. At that point, governments themselves would become financially unstable. In 2024, the amount of public debt accumulated by governments around the world hit an all-time high of $100 trillion. The debt crisis is so severe that developing countries like Kenya use more than half of its revenue to pay off loans, while the debt burden of the US is on the pace to surpass those in Greece and Italy. Thus, financial bailouts might inflate and burst yet another bubble, that of the national debt. Additionally, bailouts would drive inequality because taxpayers' money would disproportionately help the wealthiest, while failing to help the poor and small businesses. And of course, this would cripple the global economy. While this sounds scary, corrections are part of economic reality. They bring markets back to fundamentals, eliminate bad investments, and clear the way for healthier economic growth. In conclusion, the burst of AI and crypto bubbles would ultimately trigger a deep global depression, worse than any crash recorded in history. The burst of these two bubbles would be catastrophic to millions of households worldwide. And don't get me wrong, I'm not necessarily predicting this would happen because the markets are unpredictable. But when valuations of AI firms are overstretched and driven by future growth rather than proven business models, a market correction is bound to happen. Of course, both AI and crypto bubbles are built on technology that works in some extent. Many people use AI products from image generation to video generation to make their daily lives easier. But this isn't enough. Investors should be convinced that a significant return on investment is imminent. To achieve this, it's crucial for AI startups to pivot from hype to highly specific, evidence-based projections and clear strategies. Without this, market crash is inevitable. As an investor, being ready for potential downturns is the most rational thing to do right now. That's all from me. For more videos like this one, please like and subscribe. See you in the next one. Oh, man.